When I started researching LUNR, I thought the moon missions would be the center of the story. That is the obvious place to look. Intuitive Machines has already done something almost no company on Earth can do. It landed on the moon. That is the line everybody remembers. But here's the line this video is really about. The moon landing proved Intuitive Machines can reach the moon. The next proof gate is whether the company can bring the cash back to Earth. So I expected the big question to be mission risk. Can it keep landing? Can it repeat the engineering? Can it scale lunar delivery without blowing up costs? Those questions matter, but they were not the thing that made me pause. The thing that made me pause was the backlog, not because the backlog is fake. It is not fake. The company ended the first quarter of 2026 with about $1.1 billion of reported backlog. The exact number was about $1.055 billion. That sounds like the answer. It sounds like the market already has proof that LUNR is moving from space story to real business. At first, I thought the billion-dollar backlog proved the business was scaling. Then I hit the line that made me stop reading and start doing math. Backlog increased by about $842.4 million from year-end 2025. More than $600 million of that increase came from acquired backlog tied to Lanteris. The exact figure was about $612.8 million. That is roughly 3/4 of the backlog increase. In other words, most of the backlog growth was not generated by a new moon mission. It arrived when the company got bigger. Another $428.9 million came from new awards, mainly the IM-5 mission, a government defense contract and other contracts. And that was partially offset by $186.7 million of performance on existing contracts. That changed the question. There is demand. The better question became, did LUNR create a billion-dollar backlog, or did it buy most of the backlog growth? That is the central mystery. And to be fair, this could still be completely bullish. If Lanteris was acquired at a reasonable price, if that backlog converts into profitable work, and if the combined company wins larger contracts because of the deal, shareholders may not care that the backlog was acquired. So I could not stop at the acquisition number. I needed to know what happened next. At this point, I had 3 piles on my notepad. Stuff the company bought, stuff the company won, stuff the company actually delivered. Those are not the same thing. I call the danger here the backlog illusion. Not because backlog is fake, because once backlog gets big enough, investors often stop asking the next question. And the next question is the whole stock. That is the first clue in the LUNR story. The billion-dollar backlog number matters, but it does not end the investigation. It starts the investigation. Because if backlog growth eventually requires constant acquisitions, shareholders need to know that. And if backlog growth turns into free cash flow, shareholders need to know that too. The second clue was even more direct. In the same filing, Intuitive Machines reported $792.3 million of remaining fixed price performance obligations. These are firm fixed price orders where the company still has work to perform. Management expected to recognize about 60% to 65% of those obligations during the remaining 9 months of 2026, about 25% to 30% in 2027, and the rest over the following 3 years. Wait, that means investors should not have to wait 5 years to learn whether the story is working. If a large share of fixed price work is supposed to convert soon, the next filings should start showing the truth. Is backlog becoming revenue? Is revenue becoming margin? Is margin becoming cash? Or are shareholders still funding the gap? That is where this becomes personal for anyone who owns the stock. Because if revenue grows but cash does not, shareholders often become the bridge financing. That bridge can be convertible debt. It can be stock issuance, it can be an at-the-market program, it can be dilution that makes the company larger while each share owns less of the upside. That is why I do not think the LUNR debate is really about whether space is exciting. Of course, space is exciting. The debate is whether the excitement becomes cash before shareholders have to keep paying for the journey. The third clue was the size of the headline contract opportunities. NASA awarded Intuitive Machines a near space network services contract with a potential maximum value up to $4.82 billion over a base period in options. Space Force Andromeda IDIQ as an anticipated $6.2 billion ceiling opportunity tied to space domain awareness and maneuverable satellites. Those are enormous numbers. But this is where the receipt matters. Again, a ceiling is not a purchase order. A ceiling is not backlog. A ceiling is not revenue. And a ceiling is definitely not cash. Ceiling is the size of the door. Funded task orders are steps through the door. Revenue recognition is work completed through the door. Cash flow is money collected after the work, the working capital, the suppliers, the launch costs, and the capital spending. That distinction is not bearish. It is the difference between a real investigation and a headline reaction. The fourth clue came from revenue. Q1 revenue was $186.7 million, almost 3 times the $62.5 million from Q1 of the prior year. That looks like a dramatic acceleration. Then the filing gives the receipt. Product revenue was $141.6 million. Lanteris, the acquired business, contributed $141.6 million of revenue from the acquisition date through quarter end. Wait. The revenue reset was not just the old LUNR business suddenly tripling, it was heavily acquisition driven. Again, that does not make it bad. It makes the question better. Did Intuitive Machines buy a durable spacecraft manufacturing base that can turn the company into a real space infrastructure prime? Or did it buy scale that still has to be integrated, financed, and proven in cash? That is the video. Y'all, well, the real investigation is this. Intuitive Machines has already proven it can reach the moon. Now, the filings are asking a harder question. Can this company turn acquired backlog, contract ceilings, lunar missions, defense awards, and infrastructure ambition into margins, free cash flow, and per share value? Here's the one-sentence thesis. Intuitive Machines is trying to turn lunar mission proof into an integrated build, connect, operate space infrastructure platform. But LUNR only becomes a higher quality long-term stock if the receipts start moving from opportunity to funded work, from funded work to revenue, from revenue to cash, and from cash to value per share. That is a high bar. It should be a high bar. This company operates in one of the hardest engineering markets in the world, but shareholders still own a financial claim, not a souvenir from the moon. So keep this chain in your head for the rest of the video. Contract ceiling, backlog, revenue, cash, per share value. The bull case says Intuitive Machines is moving down that chain and becoming a real space infrastructure prime. The bear case says investors are staring at the left side of the chain and pricing it like the right side has already happened. Now, we can talk about what Intuitive Machines actually sells. Intuitive Machines is based in Houston. It describes itself as a space technology, infrastructure, and services company focused on cislunar infrastructure. Cislunar means the space around Earth, the space around the moon, the path between them, and the lunar surface itself. So LUNR is not simply a rocket launch company. It is trying to sell the systems that let customers get to the moon, send data back from the moon, build spacecraft, navigate in deep space, and eventually operate infrastructure as a service. The company's story has 3 official pillars. First, delivery services. This is the lunar lander business. NASA and other customers put payloads on an Intuitive Machines lander, and the company handles mission architecture, integration, landing systems, and delivery to the lunar surface. Second, data transmission services. If more spacecraft go to the moon, they need communications, navigation, timing, tracking, and data relay. That is where the Near Space Network Services opportunity, planned lunar relay satellites, ground stations, and the proposed Goonhilly acquisition fit into the story. Third, infrastructure as a service. With Lanteris, formerly Maxar Space Systems, Intuitive Machines added a much larger spacecraft manufacturing and space systems base. With KinetX, it added deep space navigation and mission design capability. Management now talks about a build, connect, operate model. That phrase is important because it changes the investment case. If Intuitive Machines were only a lunar lander company, the stock would depend mostly on lander cadence, NASA payload awards, mission reliability, and lunar surface economics. But if Intuitive Machines can become an integrated space infrastructure prime, the opportunity gets larger. It can potentially compete for defense spacecraft, NASA infrastructure, lunar data relay, deep space communications, mission operations, and long-duration space services. That is why investors care. The market often pays more for companies that look like infrastructure platforms than for companies that only complete one-off projects. But infrastructure platforms need repeatability. They need cost control. They need customer trust. They need balance sheet strength. And they need evidence that large awards become profitable revenue and then cash. Now, ask the beginner question every stock video should answer. Who pays? The first customer bucket is civil space. That is NASA CLPS work, NASA exploration priorities, lunar science, payload delivery, and related mission services. The second bucket is national security and defense. S, Space Force opportunities, space domain awareness, and spacecraft systems where government customers care about resilience, tracking, communications, and orbital infrastructure. The third bucket is commercial and partner demand. That includes companies or mission partners that need payload delivery, ground network support, spacecraft manufacturing, operations, communications, navigation, or access to the lunar and cislunar environment. The fourth bucket is prime and subcontractor relationships. In aerospace and defense, Intuitive Machines can be the visible lead on some work and a supplier, manufacturer, or mission partner on other work. That customer map matters because this is not like selling a monthly app subscription to millions of people. This is program revenue. It is contract revenue. It is engineering, hardware, integration, manufacturing, mission operations, delivery, billing milestones, and customer funding cycles. So here's the money flow. Step one, a customer has a mission problem. Maybe NASA needs science payloads delivered to the lunar surface. Maybe a defense customer needs spacecraft that can observe and track activity in orbit. Maybe a mission partner needs deep space navigation. Maybe a lunar infrastructure customer needs a communications or data relay path. Step two, Intuitive Machines wins an award, task order, contract, or place on a contract vehicle. Some of that can become backlog. Some of it may remain only an opportunity until funding, task orders, or options show up. Step three, the company has to perform. It has to design, build, test, integrate, launch, operate, manufacture, communicate, navigate, or support the mission. Step four, revenue is recognized under the contract terms. That can happen over time as work is performed or around milestones, depending on the contract and the accounting. Step five, revenue has to become gross profit. That is where contract type matters. The company performs work under fixed price, cost reimbursable, time and materials, or mixed contracts. Fixed price work can create upside if execution is efficient, but it can hurt if costs run above plan. Cost reimbursable work can reduce some cost risk, but it does not automatically create strong margin upside. Time and materials work is closer to billing for labor and materials, but it still depends on demand, utilization, and customer funding. Step six, gross profit has to survive operating expenses, public company costs, integration costs, research and development, interest, and capital spending. Or step seven, the accounting story has to become cash. That means collecting receivables, managing contract assets and liabilities, funding inventory, paying suppliers, and investing in equipment, facilities, satellites, ground networks, and mission infrastructure. Step 8, shareholders still need the per share test. Even if the company gets bigger, each share only benefits if cash generation, margins, and returns on capital beat dilution. The moon landing is the proof that gets the meeting. Cash conversion is the proof that wins the investment case. The reason LUNR became famous is obvious. In 2024, Intuitive Machines Nova, Lander, Odysseus reached the moon and returned the United States to the lunar surface for the first time since 1972. In 2025, the company returned to the lunar South Pole with a second lander mission. That matters. In space, a demonstrated mission is a receipt. It tells customers the company is not just a concept. It has built hardware, launched hardware, operated hardware, and handled real mission conditions. But for investors, that receipt is not the same as a cash flow statement. Landing on the moon proves engineering capability. It does not automatically prove attractive unit economics. A simple analogy is a restaurant in the hardest location imaginable. If a company proves it can open the restaurant, that is impressive. But investors still have to ask, how much did each meal cost to make? How many customers come back? Are the employees overwhelmed? Does the landlord keep raising the rent? And does the owner need to sell more shares every time the kitchen needs new equipment? For LUNR, the version of that question is, can the company execute missions and contracts at margins that justify the risk? Now return to the Q1 receipt, because this is where the investigation gets sharper. In the first quarter of 2026, Intuitive Machines reported revenue of $186.7 million. That was almost 3 times the $62.5 million reported in the first quarter of 2025. That sounds like a clean acceleration if you only read the headline. But the composition matters. Product revenue was $141.6 million. Service revenue was $42.1 million. Grant revenue was $3.1 million. The big reason the revenue base changed was Lanteris. Intuitive Machines closed the Lanteris acquisition on January 13th, 2026, and the acquired business contributed $141.6 million of revenue in the quarter. So do not treat the Q1 revenue jump as purely organic lunar services growth. It was a step change created by acquisition. That does not make it bad. It makes the question more specific. Did Intuitive Machines buy a durable manufacturing and space systems base that strengthens the whole platform? Or did it buy revenue that still has to be integrated, financed, and converted into cash? On the earnings release, management highlighted positive adjusted EBITDA of $2.7 million. Adjusted EBITDA is useful, but beginners need the translation. It is earnings before interest, taxes, depreciation, amortization, and several other adjustments. It can help show operating trend. It is not the same as GAAP profit, and it is not the same as free cash flow. Under GAAP, the first quarter still showed an operating loss of $39.2 million. Net loss attributable to the company was $37.4 million. Operating cash flow was negative $54.8 million. Purchases of property and equipment were $9.9 million, which means free cash flow, using the company's own definition, was about negative $64.6 million for the quarter. That is the tension in one paragraph. Revenue scale improved. Backlog improved. Adjusted EBITDA turned positive. But GAAP operating loss and cash burn were still real. That is why the next few filings matter so much. If revenue growth is followed by better margins, stronger collections, and lower cash burn, the story improves quickly. If revenue growth is followed by more working capital pressure, more lost contracts and more share issuance, the backlog trap gets worse. The balance sheet also changed sharply. Cash and cash equivalents were $231.6 million at March 31st, 2026, down from $582.6 million at the end of 2025. A major reason was the cash portion of the Lanteris acquisition. Working capital was $89.8 million at quarter end. Management said the cash balance, the February equity raise, and the convertible note proceeds were expected to be enough to fund short-term liquidity needs and the business plan for at least 12 months from the financial statement issuance date. That is useful runway language. But it should not be confused with proof that the business is permanently self-funding. The company also said expected cash uses include working capital, general corporate purposes, capital expenditures, research and development, and potential mergers and acquisitions. That is why free cash flow and capital discipline still sit in the center of the thesis. The company said the Lanteris deal had about $851 million of consideration. That included $403.3 million of cash, $43.7 million of transaction bonuses treated as consideration, and about 23 million Class A shares valued at about $404 million. That is not a small bolt-on. That is a company-changing acquisition. It brought spacecraft manufacturing capability. It brought customer relationships. It brought inventory, property, equipment, intangible assets, orbital receivables, and backlog. It also brought goodwill, liabilities, warranty obligations, pension and post-retirement obligations, and integration risk. In the Q1 filing, Lanteris contributed $141.6 million of revenue and $0.2 million of operating income from the acquisition date through the end of the quarter. That one detail matters. The acquisition can make Intuitive Machines much larger, but scale alone is not the goal. The goal is earning power. If Lanteris lets Intuitive Machines bid on bigger contracts, build spacecraft in-house, combine lunar services with national security systems, and improve margins, the strategic case gets stronger. If it mainly creates complexity, amortization, integration costs, working capital pressure, and share dilution, the strategic case gets weaker. The proposed Goonhilly acquisition fits the same pattern. In May 2026, Intuitive Machines announced an agreement to acquire Goonhilly Earth Station and ComSat. The pitch is to add deep space ground station assets, antennas, and space-to-ground communications capacity, then combine that with Intuitive Machines' lunar relay strategy. Strategically, this makes sense. If you want to build lunar infrastructure, communications cannot be an afterthought. More missions mean more data. More data means more demand for ground stations, relay satellites, scheduling, tracking, and navigation. But as of the announcement, the Goonhilly acquisition was still subject to closing conditions, including regulatory approvals. So it should be treated as potential strategy, not completed proof. Completed proof is what is already in the filing. Pending strategy still has to close, integrate, and perform. Now the risk stack. Risk number one is mission risk. Space missions are unforgiving. Delayed launches, launch failures, lander issues, satellite deployment issues, and payload failures can all disrupt schedules and economics. The company itself flags risks around launch delays, launch failures, failure of lunar landers or satellites to reach planned locations, and reliance on a single launch service provider for lunar missions. That matters because these contracts are not simple software subscriptions. They are complex physical projects with hardware, suppliers, launch windows, testing, integration, and unforgiving deadlines. Risk number two is fixed price contract risk. A fixed price contract can be attractive if a company executes well. The customer pays an agreed price, And the company keeps the upside if costs come in low, but if costs come in high, the company absorbs the pain. In the Q1 filing, Intuitive Machines disclosed loss contracts tied to lunar payload missions. The IM-3 mission contract had become a loss contract, was about 89% complete, and still carried a current contract loss provision. The IM-4 mission also had a loss provision. That does not destroy the story. Early programs often have learning costs, but it is a warning. For the investment case to improve, future mission work should show better cost control, fewer loss provisions, and more evidence that experience is creating scale benefits. Risk number 3 is customer concentration. In Q1 2026, 4 major customers accounted for 36%, 26%, 13%, and 13% of total revenue. The prior year quarter had 1 major customer at 78% of revenue. Customer concentration is normal in government space contracting, but it makes revenue lumpy. If NASA, the Space Force, or another major customer changes timing, funding, requirements, or procurement decisions, the impact can be much larger than it would be for a diversified consumer company. Risk number 4 is capital structure. Intuitive Machines issued $345 million of convertible senior notes in 2025. It issued $175 million of Class A stock to institutional investors in February 2026. And in June 2026, it set up an at-the-market program that may sell up to $500 million of Class A common stock over time. That does not mean the company will immediately sell the whole amount, but it does tell investors something important. This is a capital-intensive business, and management wants access to more capital. If the stock price is strong and the company raises capital intelligently to fund high-return infrastructure, that can support the long-term plan. If cash burn remains high and share count keeps rising just to cover execution gaps, existing holders get diluted. Now, competition and moat. That is true, but it is not enough. Lunar delivery, spacecraft manufacturing, national security space systems, data relay, ground networks, and cislunar services all attract serious competitors. In lunar and exploration markets, Intuitive Machines competes around programs where companies like Astrobotic, Firefly Aerospace, Lunar Outpost, Astrolab Venturi, Lockheed Martin, Blue Origin, and others can appear depending on the mission. In Lanteris-related civil, defense, and commercial spacecraft markets, the competitive field can include large primes and specialized space companies such as BAE Systems, Boeing, Lockheed Martin, Northrop Grumman, SpaceX, Voyager, K2 Space, Millennium Space Systems, Rocket Lab, York Space Systems, Airbus, Astranis, and Thales Alenia Space. For ground network and communications work, the field can include companies like Kongsberg Satellite Services, Swedish Space Corporation, and Telespazio. Do not treat that as a perfect one-for-one peer list for every LUNR product. The point is that Intuitive Machines is not competing in an empty market. Some competitors are larger, some have deeper balance sheets, some have longer procurement histories. Some customers or primes may also build capabilities internally. The real moat would have to be a combination of mission heritage, NASA trust, cislunar operating experience, lander engineering, data transmission assets, spacecraft manufacturing through Lanteris, navigation capability through KinetX, regulatory and procurement competence, and the ability to bundle these pieces into funded customer programs. The danger is that the same breadth can become complexity. If delivery, data, manufacturing, navigation, and ground assets reinforce each other, Intuitive Machines starts to look like a real platform. If they remain separate projects with separate cost structures, separate integration problems, and separate capital needs, the platform story becomes harder to prove. Now, build the bull case. The bull case starts with credibility. Intuitive Machines has flown real lunar missions. It has NASACLPS history. It has a 5th CLPS task order that requires the larger Nova-D lander. It has the Near Space Network Services opportunity. It has acquired a larger spacecraft manufacturing base through Lanteris. It has deep space navigation capability through KinetX. And it is trying to connect delivery, manufacturing, communications, and operations into one infrastructure platform. The bull case also says the customer proof is getting broader. The Q1 release described $428.9 million in new contracts driven primarily by the Space Development Agency Proliferated Warfighter, Space Architecture Tranche 3 tracking layer, and a $180.4 million NASACLPS contract. Space Force Andromeda IDIQ as the first revenue synergy award combining Intuitive Machines and Lanteris capabilities. It is lunar delivery plus defense spacecraft plus space domain awareness plus data relay plus manufacturing plus mission operations. In the best version of the story, the market is moving from one-off space missions to persistent infrastructure. The moon is not just a destination. It becomes a place where governments and commercial customers need delivery, data, navigation, power, mobility, landing services, relays, and long-term operations. If that transition happens, Intuitive Machines does not need to win every part of space. It needs to be one of the trusted companies that can handle complex missions in the Earth-Moon system. The bull also points to 2026 guidance. Management guided to full year 2026 revenue of $900 million to $1 billion in positive adjusted EBITDA. If the company hits that range while improving cash flow, managing integration, and keeping mission milestones on track, LUNR becomes more than a moon headline. It becomes a scale story. Now, the bear case. The bear case starts with the same facts, but reads them differently. Q1 revenue grew because of a large acquisition. A large share of the backlog increase was acquired backlog. GAAP operating loss was still meaningful. Operating cash flow was negative. Cash fell sharply after the acquisition. The company has convertible debt, recent equity issuance, and a fresh at the market program. Backlog is real, but not the same as profit. Contract ceilings are exciting, but not guaranteed revenue. Fixed price lunar contracts have already produced loss provisions. Customer concentration remains high. Government budget timing matters. Mission failures or delays can change the economics quickly. The bear case is not that Intuitive Machines is fake. That would be too simplistic. The serious bear case is that the company may be real, important, and technically impressive, while the stock still gets ahead of what the financials can support. That happens often in frontier industries. Investors fall in love with the size of the possible market. Then the filings remind them that the path from possibility to cash flow is long, expensive, and uneven. So what should investors watch? First, use a next report checklist. Do not only ask whether revenue beat a headline number, ask whether revenue is tracking toward the $900 million to $1 billion full year guide. Ask how much of the revenue is Lanteris, how much is legacy lunar services, how much is data transmission, and how much is other infrastructure work. Ask whether gross margin and adjusted EBITDA are improving without hiding GAAP losses or cash burn. Ask whether operating cash flow and free cash flow are moving toward break even. Ask whether backlog growth is organic, acquired, or mostly contract ceiling narrative. Ask whether IM3, IM4, IM5, Nova-D, NSNS, SDA, Andromeda, and Goonhilly milestones are moving from announcement to funded execution. Ask whether share count, ATM usage, and debt conversion risk are staying disciplined. That checklist keeps the story grounded. Now put the thesis into 5 proof gates. First, revenue conversion. Can Intuitive Machines move toward the $900 million to $1 billion full year revenue guide? And what is the mix? How much comes from Lanteris? How much comes from lunar delivery? How much comes from network and services? How much is acquisition driven versus organic? How much backlog is converting on the timing management laid out? Second, cash conversion. Do not stop at adjusted EBITDA. Watch operating cash flow, free cash flow, receivables, contract assets, contract liabilities, and capital expenditures. A stronger company should eventually show that backlog converts into cash, not just revenue recognition. Third, mission execution. Watch IM3, IM4, IM5, the larger Nova D lander, new CLPS task orders, and major program milestones. The question is not whether every mission is perfect. Space is hard. The question is whether execution improves and loss provisions shrink as the company gains experience. Fourth, network proof. Watch near space. Network progress, lunar relay development, ground infrastructure, and whether Goonhilly closes and integrates. If Intuitive Machines wants to be a communications and data infrastructure company, the market needs proof beyond lander headlines. Fifth, capital discipline. Watch share count, ATM usage, debt conversion risk, acquisition integration costs, and whether new capital is funding growth or covering cash burn. The company can become bigger while each share owns less of the upside if cash conversion does not arrive quickly enough. That is the research frame. LUNR has already proven it can reach the moon. The next proof gate is whether it can turn a growing pile of contract awards into repeatable cash generation. If the next filings show revenue converting, cash flow improving, backlog staying healthy, mission losses shrinking, and dilution staying disciplined, the bull case gets stronger. If the next filings show big headlines but weak cash flow, more lost contracts, heavy ATM usage, customer concentration, and delayed missions, the bear case gets stronger. The moon landing got investors to look. Contracts to cash will decide whether they should keep believing. This is not financial advice. Always do your own research.